About a month ago, I made a video on QYLD. That's a very popular covered call ETF right now, since it pays between 11 and 12% dividend each year. It's pretty cool. But I'm deeply concerned that the typical QYLD investor is just reinvesting their dividends right back into the ETF and trying to manufacture a growth instrument out of this income fund. I outlined some of the problems I see with that and recommended QQQX as an alternative to QYLD. That's still an income fund, but it's blended with growth, and that makes it much more suitable for the young investor that I typically see throwing their money into QYLD. I think a lot of people did agree with my point of view, and although there were some people that were really angry at me or got mad that I didn't say you can also swing trade QYLD if you really want to, I think by and large the assessment did hit home for a lot of people. But I really underestimated how many people would ask about QYLG as an alternative to QYLD instead of using QQQX. And I really underestimated how many brokers out there, including Robinhood, wouldn't list QQQX as an option. So you guys bring up a great question. Why not QYLG? So here's how these three funds work. So QYLD buys the NASDAQ index and sells covered calls on 100% of its holdings. That's great for income because you get a lot of premium for it, but it doesn't leave any room for growth. QQQX's managers, David, Jim, and Lei Lau, actively choose between 35% and 75% of their holdings to sell covered calls against. That means you're always blending income and growth, but it does vary quarter to quarter. QYLG is always 50-50, so it sells covered calls on half of its holdings and leaves the other half available for growth. The management fee on QYLG is also lower than QQQX. QQQX comes in at 0.89 and QYLG at 0.3. So if all other things are equal, then QYLG should appreciate a little bit faster than QQQX. So again, what makes QQQX better than QYLG? So far it sounds like QYLG is actually the better choice. Well, here's the very simple reason why I still prefer QQQX. In general, there's about 4 types of distribution a company can make. The first is dividend, the second is return of capital, the third is MLP distributions, and the fourth is capital gains. Don't worry about MLP distributions for now, and we all know about capital gains. We might not have as many of them this year as we did last year, but we know what they are. What I want to focus on is the other two. The dividends versus return of capital. Dividends get taxed. Now, the rate of taxation depends on your tax bracket and how long you held the stock or the fund. But unless you're in the 0% tax bracket for both non-qualified and qualified dividends, you're going to spend some money on taxes when you receive your dividend income. A return of capital, on the other hand, does not get taxed. From the accounting point of view, what a return of capital is that the company is giving you your own money back that you invested rather than giving you a distribution of their profits. This takes some accounting rigmarole to achieve this, but it is beneficial to you as the shareholder. You don't have to pay taxes on your return of capital until the fund has already returned 100% of what you spent on each share. After that, you start having to pay taxes on the additional distributions. In other words, you can't receive more than 100% return of capital without getting taxed on everything beyond 100%. So how does this play into QQQX versus QYLG? One of QQQX's stated goals is to tax optimize their fund. To the extent possible, they take steps to make sure that each quarter the money that you're receiving in distribution would be taxed less than you would get from other dividend funds. That's why we pay that extra 0.3% management fee. Historically, QQQX's management has done a pretty good job of making sure that you're receiving return of capital. The most recent distribution is going to face some taxes, but the previous 7 were all almost entirely returns of capital. This keeps your taxes relatively low on QQQX's distributions. QYLG does not do this. They do not aim to tax optimize their fund. So what you receive in distributions from them is always going to be taxed as either a dividend or as a capital gain. That's the same situation with QYLD. So for that extra fraction of a percent of a management fee, what you're getting back is savings of 20%, sometimes even more than that, in taxes on your distributions. In my dividend portfolio, I like knowing that almost all the money I receive from QQQX distributions is not going to face any tax until I've already received back all the money that I spent on those shares. As for comparing the actual performance of the two funds, QYLG is pretty new, it's only about 18 months old, so we can't do a long-term comparison between QQQX and QYLG. Since QYLG started trading, it goes back and forth in that leading position with QQQX. It looks like QQQX does a little bit better during those bull markets, and QYLG does a little bit better during bear markets. But they're really, really close. And since QQQX and QYLG haven't been trading together for a very long time, right now they're both within 1 day of outperforming the other. I think once we look at the tax advantages of QQQX and we look at the comparison of dividends, QQQX is about 7.6%, QYLG about 6.3%. I think we'll find that most people that need a blend of income and growth are better off with QQQX instead of QYLG. Now, with all that said, there are some advantages to QYLG. QYLG pays a monthly dividend instead of QQQX, which is a quarterly dividend. So if you're living on fixed income, it might actually be better for you to get that monthly distribution so you can do more budgeting. Also, I know a lot of brokers don't even offer QQQX because it's a mutual fund instead of an ETF. So if you're on one of those brokers that doesn't offer QQQX, QYLG is a perfectly valid alternative to it. It's not quite as optimized for me as QQQX, but it might be just fine for you. And by the time you really have a large portfolio that's bringing you significant dividend income, you'll probably have already moved over to a full-service broker that does offer QQQX. So if you ever decide to make the change later, you can still do so. And even if you do want to go with QYLD after all, I think that's still fine as long as you're taking that distribution and putting it into a more growth-oriented fund. I know it doesn't feel like the right time now to be throwing money into growth assets with QQQ coming off 15% in a month and a half. But I promise you the day will come when we start climbing out of this bear market. And when we do, you'll be happy that you have some growth assets blended with your income assets. That way you can still get the mix of income and growth that you need. Or if you're properly retired and living off of your dividend, then the 12% dividend from QYLD might be much better for you than the 7.6% from QQQX, even if it means at the expense of growth. If you're living off of the dividend, and that's what you need, then you don't need to worry about growth. Just get the dividend. But like I've said before, most of the people I see investing in QYLD are not living off their dividend, so they need a blend of growth and income, not straight income. For all the people in their 20s on the QYLD gang subreddit that are all buying up shares of QYLD, if you insist on doing that, I ask you to at least consider throwing some of that distribution into growth funds. Once that line starts going up again, you're going to be really happy that you have growth assets that can take advantage of that climb. When the day comes that you are ready to properly retire, you'll be very happy to have seen that all of those growth assets have appreciated in value, so you can sell them for a lot more than you would have just made by reinvesting into QYLD. Once you've sold those growth assets, you can move it over to dividend and income later when you're actually ready to start living off of fixed income. That's all. I hope you guys found this video helpful to you, and good luck riding out this bear market. I'll see you next time.